When you see the whole world shaking and you feel your heart is breaking, take my hand, no hesitating. When you're just so tired of trying, all alone you feel like hiding. Together we'll keep fighting. There's no stopping us. Hold on, we're gonna make it. We're gonna make it. Don't stop now. Hold on, we're gonna make it. We're gonna mountains too high we can climb it. Feel it, we're taking the moment. There's no stopping us. Hold on, we're gonna make it. We're gonna make it. Can you see the sun is shining like a new hope? Feel it rising, coming over the horizon. There's no stopping us. Hold on, we're gonna make it. We're gonna make it. Don't stop now. Hold on, we're gonna make it. We're gonna mountains too high we can climb it. Feel it, we're taking the moment. There's no stopping us. Hold on, we're gonna make it. We're gonna make it. Don't you give up, don't you give up on me. Don't you give up, don't you give up now. Don't you give up, don't you give up on me. Don't you give up, don't you give up now. Don't you give up, don't you give up on me. Don't you give up, don't you give up now. Don't you give up, don't you give up on me. Don't you give up, don't you give up now. There's no stopping.
Good evening. But it's actually, I'm recording it a little bit earlier. It's about 5:40. I just wanted to get this done and work on some things. So it's about 5:40, but it's still October 8th. I'm Chris Gargiulo. I'm an associate broker for EXP, and this is my weekly video podcast of real estate with Mr. G. And it will also be uploaded to Spotify. And you can listen to me while you're working out, while you're at the gym, while you're jogging, before you go to bed, whenever. And so you just two different mediums that you could listen to me or watch me. And we talk about issues dealing with today's real estate market, and sometimes we have guests coming in, and we have different things to talk about, but all dealing with real estate and mortgages. Today we are going to talk about mortgages, and that's the big issue right now because they went up to 7%, and a lot of people who were looking, they stomped on the brakes, and they're holding off, hoping that these rates will come down. But I don't think so. Okay, I don't think it's going to happen in the near future. So we have a lot to talk about. I'll do my intro first. I usually then go right into the PDF. You know, I usually have an article to go along with it, but let me do my intro, and then we'll hit the road running, dealing with mortgage rates today, and how can we deal with it? Okay, what are ways to beat these high mortgage rates? If you saw my little photo that I took before I did the video, I put my championship belt up here, and I'm going to help you beat those high mortgage interest rates. Okay, so let's go and let me do my little intro, and we'll go right into the work. I know that intro is a little bit different, and it's, sounds like music for a Western. I wanted something different. I'm tired of these dancing videos that's going on TikTok. I just wanted something, old-fashioned Americana, and showing the wide range of backgrounds and vistas of America. And I wanted to do that. And so it may work, may not work, but I was going to try that for a while. Okay? So we're going to talk today. You'll see my little caption there, should I wait for rates to come down? And it's funny, preparing for today's podcast, I came across an article, came out about 9 hours ago, and it's on the I don't know if they're in print and copy, but Business Insider. And I like Business Insider because they take, they're not always looking for the sugar-coated, flowered lens of what's going on. They kind of like really deal with what's going on and not trying to, as I just said, sugar-coat it. And so they have, this just came out, and let me see if this shows up on my stream, and it says, and this actually just came out about 9 hours ago. The stock market is headed for a new 2022 low in October after a strong jobs report strengthens the Fed's case for more hawkish rate hikes. BofA, the Bank of America, says. Pretty sure that's the Bank of America, and we had it wasn't a great jobs market, but it was still chugging along. And so this is giving fear to the Federal Reserve that we're still not out of this period where people are still buying frantically, and companies are deciding to expand. They want to put a halt on that, and that sounds kind of negative, right? That you want to stop that, but as this is like a cause in economics. But as people buy more products, companies will then, they will expand and hire more workers and buy more supplies, and that after a while, as they're starting off. This process could and most likely will increase prices for different products. Okay, demand is high, and we might be at a point right now, especially with the problems we have with our chain of supply going. We don't have that supply to meet that demand, so most likely prices will go up. Okay, until we have everything working fine, within the economy. After a while, when companies build up so much inventory, and maybe demand might slack a little bit, but they need to sell off that inventory, and then they'll bring down prices. But right now, we have the economy chugging along, and that may sound good, but it's not good for prices of items that we buy, especially groceries. I really see what's going on with the grocery market, because I'll admit it, I do most of the grocery shopping in our family, because I like to buy a lot of food. Okay, and I'll buy, I'll go around, if I see something there I never tried before, I'll buy it. And it's always the brand name of the company that's premier in that field, right? I'm not buying, back in New York, we had Key Food and Pathmark. Key Food would be their brand name, right? So you're not buying the Green Giant peas, you're getting Key Food peas, right? Or what's the other one? Bird. Well, I can't think of it right now, but you're going with the store brand. It's usually, well, it is cheaper, okay? When you go with the store brand. Here we have Harris Teeter and Food Lion, Kroger. So if you go with their brand name, it's a little bit cheaper. But even those prices are going up of the store named products. So we have the problem right now, and we got to get that under control, because it's really, it's hurting a lot of people. I mean, you might not have to buy a car this year. You might not have to buy a new refrigerator. You may not have to buy, a washer, okay, or a outdoor, a hot tub or whatever. But we need to buy groceries every day. We need to buy groceries, and we need to buy gas. And this is what's hurting people. And the way to do this is to pull the reins on lending money to people and to companies to do this, to buy more, to expand more. And that's what the Federal Reserve does. Now, as I have said in all my, and now it's many podcasts, is that the Fed fund rate doesn't affect directly mortgages, but it's kind of like a domino effect. So if they start moving this up, and they're talking about another 0.75 of a point the next time they meet, meaning the Federal Reserve, within days or a week, the mortgage rates will go up as well. So we really do not see mortgage rates coming down in the near future. Okay? So I'm glad this article actually came up as I was preparing for today's, because it's right, it hits the nail right on the head. All right? Now, I'm going to show my PDF now, and then we're going to talk. I put together a little video on ways you could combat higher mortgage rates. But let's bring this up here first. I'll make my little bubble that I like. The cost of waiting for mortgage rates to go down. So we know that the rates have increased. Let me get my little highlighter pen out. Have increased significantly in the recent weeks. And that may mean you have questions about what this means for you if you're planning to buy a home. Here are some information that can help you make an informed decision when you set your home buying process, okay? So we know that as the rates go up, your monthly mortgage number will go up as well. And your eligibility to purchase a home is based upon how much you could pay on a monthly basis on a mortgage, right? So you may have been approved, let's say, on a home that was, in this case, let's say, rounded off to $290,000. Okay, but and the mortgage rate, or I should say the well, I'm going to move down to the chart, but let's build up over here. Let's take it back a notch to this area here. Let's assume you want to buy a $400,000 home. The median price home, according to the National Association of Realtors, is $389,500. If you're trying to shop at that price point and you keep your monthly payment about $2,500, $2,600 or below, here's how your purchasing power can change as mortgage rates climb. See the chart below. The red shows payments above that threshold, and the green indicates a payment within your target range. Okay? So as that mortgage rate goes, let's look at the very bottom. And actually, we're past 6%. So on that mortgage, on that monthly payment on that mortgage at 6% is $2,638. Okay? But as we're getting now, we're up to about 7%. So now your monthly payment on that mortgage on the home, that's $440,000, is $2,927. Now, what they did here, this is actually working here. They're going with the higher rates, and the reason why they're going with the higher rates here, or I should say, the higher price of the home, because along with mortgage rates going up, we expect home prices to go up as well, even though some individual homes have gone down. So they're looking at I don't know if I would say it's the median or the average. I might say with the average, where the majority, the average homes or the homes you have on the market, okay, a good portion of them, up to maybe the majority, okay, will still increase. But you will have homes that may need some work, and the seller and their agent thought, okay, it's still a seller's market. I could sell it if it needs some repairs or needs some sprucing up. And they are finding now, both the seller and the seller's agent, that that's not happening. We're actually going to see a little film on that, where people are asking, buyers are asking for more repairs. All right. But we could see when that house, let's say, was at around $380,000, they could go up to a mortgage rate if they want to keep their monthly mortgage payment between $2,500 to $2,600. They could still afford that house or be eligible for it. All right, but at the point that they reach 7.5, they will no longer, and let me circle it, they would no longer be eligible for that mortgage, right? Because it's going out of what they have been approved for. And if the price of the homes go up, okay, we see that drop here significantly. Here, if it goes to $400,000, once it bypasses 6.75%, they will no longer be eligible for the home, all right? And here what they did, up to $420,000, and then actually once it reached $440,000, even at the lower rate of 6%, they are no longer eligible for that amount. So your buying power is going down, okay, as these rates go up. Now, the big thing, what they're saying here, are mortgage rates going down. The rise in mortgage rates and the resulting decrease in purchasing power may leave you wondering if you should wait for rates to go down before making your purchase. Realtor.com says this about where rates could go from here. Many home buyers likely winced upon hearing that the Federal Reserve yet again boosted its short-term interest rates by 0.75 percentage point. And again, we're actually expecting that for the next meeting. A move that's pushing mortgage rates through the roof, and the already high rates are just going to get higher. So if you're waiting for the mortgage rates to drop, you may be waiting for a while as the Federal Reserve works to get inflation under control. And if you consider renting as your alternative while you wait it out, remember that it's going to get more expensive with time to do so. There is no doubt that these higher rates hurt housing affordability. Nevertheless, apart from borrowing costs, rents additionally rose at the highest pace in the nearly 4 decades. So if you think you are going to save money by continuing to rent, you're sadly mistaken, because they're going up. Because the rents have gone up. And actually, we talk about housing inventory for sales being low. So is the availability of rental apartments and homes. It's really down pretty low. So there's really no advantage here by keep on renting if you're able to purchase. If you've been pre-approved and you could find a home that's in your price range. So let's get back to me here. We're going to close this out. And I'm going to make myself nice and big. Okay. So again, the mortgage rates will continue to go up. It might stop at the first quarter of 2023 and then stay there. And then we'll see what happens afterwards. If we do go into recession, I'm not so sure if that's going to happen. I mean, we see some cutbacks here and there, but it's not going to be across the board. All right. And that's in my opinion. All right. You could read articles saying differently. I'm going based upon what I've seen in the New York Times and the Wall Street Journal. I belong to, like I said, Business Insider. I also have Housing Wire. What I probably will see, and we will all see, is that the home prices will begin to settle at a certain plateau. They're not going to increase anymore. I really believe that, because the mortgage rates are too high. And sellers have been getting offers much higher than what they've been asking for. I mean, now it's stopped, but let's going back from 6 months to a year to a year and a half. So right now, the market, to me, is overpriced. All right. Because don't forget, once that person or that seller sells the home above the market value or the appraised value, because the buyer came in and they get the appraisal, so they said, all right, it's you want to sell the house for $300,000. Even if the appraisal comes in at $280,000, I'm going to pay that difference. And then that house, once it sells, becomes a comp for other homes. So it begins to push up the values of all the homes. Okay. So after a while, it's like with anything else, and that's a form of inflation as well, right? The high home prices, and what we're trying to do is to bring it back down to where it should be, where the true value of the house is. And I believe, with the articles that I've read, in fact, we're going to see a little video on that, is that buyers are beginning now to negotiate on getting certain items fixed on the house or asking for seller concessions. So we're seeing more of that. So it's changing, all right. But we're still dealing with an inventory that's getting better. More homes are going on the market, but it's not at the point where it was maybe about 2 or 3 years ago. We do need more listings, okay? My potential sellers out there would love to get your house to list. So I put together this little, it's not even a minute long, but it kind of like highlights what can you do to deal with these extremely high mortgage rates. And that's just the image. I want to show the video. Okay. Okay. So let me put together. I screenshot the outline here. So dealing with high mortgage rates, what can we do? Ask loan officer if you can buy down the interest rate. They will tell you by how much you would have to put down to buy down the interest rate. You might be able to buy down perhaps a half point, a quarter of a point. You could also ask for the seller, not saying that you could say in your contract, you want to sell a concession to buy down points, you put it that way. And within if you're asking for 3% back, you could use that money, all right, to buy down the rate. Okay, so actually the seller could help you with that. And again, we're going to see as we have an inflection point in the real estate market where sellers are now offering concessions. If possible, you can make a larger down payment. The more you put down, the less you are borrowing, and it will decrease the mortgage payment. You really have to put down a good amount of money, though, to make a dent in the payment. Now, you could get gift funds. I should add that as well. If a parent or a relative would give you some money and to help you put down more of a down payment, or perhaps buy down the rate, you could do that. And it has to be a gift fund because they will need to put together a letter saying that this amount does not have to be paid back. Because if they don't, then it adds more to your debt. So you don't want to add more to your debt and saying, well, now I have to pay this also. It's like having another credit line. So the gift letter saying that it does not have to be paid back. Now, you could pay them back. But if you don't, the way this gift letter is, they can't take you to court and say, well, I want money back for this. And they would say, well, it's a gift. You agreed that it was a gift. Okay. Inquire about grant programs. Some banks will offer that. Okay. The ones I worked with, a lot of times they get funded every quarter, and you have to apply for it as soon as you put in a contract on the house, because they go pretty fast. Like they're replenished, but you want to get it going as soon as possible. Most of the time, these grants are income-based, but they're very liberal. You don't have to be like only making, and if anybody's out there making $20, I'm not making, but if a couple of years ago, more than a couple of years ago, a young man got a grant that I got him a house, and was making about $37,000. He was by himself, and he got the grant. And the more people that will be living in the house. So if you have a wife and you have a child, those income amounts go up. So perhaps you could be making $50,000 a year and still get a grant program. And a lot of times they go for, well, not most of the times they go for your down payment and or your closing cost. Okay, so that's very helpful. Now I added this one. You don't hear people talk about it or articles about car loans, but I know that a lot of people, and in our area we have a lot of military. And once you're in the military, you sign up for 4 or 5 years, and most likely you go to re-enlist. So banks that are giving you loans on cars that are paid out in 3 to 5 years, they feel pretty, they feel that's a good loan. You signed up in the military, you got to stay in there. I mean, if you go AWOL, you don't want that to happen. So you have a pretty secure income, right? You're not going from job to job. And a lot of young people get these car loans, and then they buy these gigantic trucks, and they're extremely expensive. I had one guy, he was no longer military, but he, no one knows what I'm talking about. So, he got divorced from his wife, and all he always wanted is a big, big truck. And the mortgage payment was like about, I'm sorry, the car payment was about $900 a month. And with that payment, we could not get him a loan. If he had sold the car or the truck and bought something less expensive, then yes. But he wanted to hold on to that truck, so the truck was more important than home ownership. So, and I've gotten people mortgages. Well, my loan officers have gotten them mortgages after they either, sometimes they were able to refinance the car loan and they got a lower rate, and then they were good, or they just traded in and got a less expensive car, and then that worked. So sometimes you could look at what you have that you're paying out on a monthly basis, and if one is a big car note, well, maybe you could sell that car, buy a less expensive one, buy a rented one, or whatever. But these are things that can help, and they have helped in the past. And then I have adjustable rate mortgages. In 2007, 2008, that messed up a lot of people. But they've changed, and they're more careful now. Meaning, let's say you bought a house for $300,000. You were approved at a monthly mortgage payment of $1,200, and let's say at that point it was adjustable rate mortgage that started at 2%, and it had a 5-point cap. It will only go up to 7%, but they approved you at that 2%, and you were fine. But once it moved up, adjustable rate mortgage, right? Adjustable means that it'll change and it will go up. So they offer you like a teaser rate first. And what happened with a lot of people going back to 2007 is that once that rate went up, they could no longer afford the home. And they had to foreclose on property, right? They lost their homes. Now, what the banks do, let's say the highest that could go is 7%, and let's say at that 7%, your mortgage would be $2,000, to make it very simple, all right? And they would see if with your income that you have today and the debt that you have today, could you make a $2,000 payment towards a mortgage? And if it's yes, then you could get it. And you're a lot safer by doing it. Now, what's going to happen is that eventually your mortgage rate with an adjustable rate mortgage will go higher than the current rate. So let's say it's, because I use 7 and we're already at 7. Let's say it's 6%, right? But now you went up to 7%. So now you're actually paying above a fixed rate mortgage. Now, there's a couple of things, or a couple of philosophies or mindsets with this. That if you know you're not going to stay in the house more than, let's say, 4 or 5 years, and this is just the start of the home, and you want to move, afterwards, then there's a safe bet to go to adjustable rate mortgage, because there's a good chance the interest rate that you will be paying will be less than the current mortgage rate. All right. If you're going to stay there long term, you could still go with adjustable rate mortgage. But what you could do, if it goes much higher than the current fixed rate, you could always refinance your home. All right. It's going to cost you because you're going to have closing costs. But when you look at the long term about how much money you'll be saving, it most likely will be the better deal to refinance. And the last thing I have now, buy now rather than later as rates increase, because we definitely see rates to be increasing. Okay? All right, so let's close this out. And that's, I apologize. I got to go back to here. And then I need to close it out over here. Okay, there we go. And I could close this out here as well. I don't need this anymore. And then there's just me in a nice little circle. And I open that up there. All right. So if you really need to purchase within the next 6 months, even through a year, don't wait any further. And if you going to buy, if you could use those options that I showed to deal with the higher interest rates, then you go about doing that. All right. So remember, it's now about 3 weeks ago that I got in the full buyer guides and the full summer guides. Okay. If you're listening on Spotify, I'm showing you graphics of the guides right now. And you could get it by going to my blog and go to realestateWithMrG.blog -resource or /resource-materials. But you just go to the main page of realestateWithMrG.blog, and on the menu you click resource materials, and it will bring you there, and you could download them for free. Oh, I also was going to show you my the video on how the market is changing. It's not 100% the buyer's market right now, but there are better there are more benefits now for buyers. So let me just show you that little video, about 2 minutes. Okay, like I said, the sellers are offering more concessions. They might be coming down on price, and so hasn't swung all the way to the buyer side yet, but it's getting better for the buyer. Okay. And so I'm hearing from my producer, William Burgess, that we have someone in the audience, a celebrity that has a very particular talent. Is that true, William?
Yes, Chris. We have an unusual celebrity in the audience with a unique skill. Italian-born, Brianna Benedetta Francesca Beneventi always had an insatiate appetite and would devour food as soon as she reached the dining room table. To help control this urge, Brianna would bite the dining chairs and then swing the chairs around in order to avoid overeating. She did it so well that her father, Pietro Antonio Beneventi, an Italian talent agent, decided to make an act out of it. Ladies and gentlemen, Miss Beneventi.
That is amazing. That's some talent. Okay. So I went over my 30-minute. We're about 41 minutes right now. So I'll see you next week. I'm going to try to. I worked with a mortgage loan officer before. Did a podcast with them going over their rules and regulations for applying for a mortgage. I'm going to see if I can find someone who could talk about ways of dealing with the higher mortgage rates that I discussed today, especially to talk about the adjustable rate mortgages, which if you do it smartly, if you plan it out, it works very well. Okay? So have a nice week. It's getting cooler today, this week. I mean, this weekend was cool. We're getting close to Halloween and more of the holidays. But I mean, the Halloween now is like really the beginning of the holiday season. It's not Halloween. And then Halloween, and then the day after Halloween, we start hearing Christmas music on the radio. So that's really the stretch, So you have, but people already have a lot of their Halloween decorations up. So October, November, December, that's the whole holiday season now. So we're getting ready for that, and hopefully I'll have a lot of fun stuff to show you and talk to you about, that's informative and also fun, okay? So there's a new booster that's out, okay? And the wife are going to get it this week. I think it's important to get it. We're getting into those cooler months, and we stay more inside. We're not out in the fresh air. I think it's good if you get it. Okay, that's my personal thing. I'm going to get it. The wife is going to get it. And so we make sure that this virus does not come back in full strength, okay? And be kind to each other. And remember, the greatest power we have is to love, and the greatest gift, each other. And I'll see you next week.